Greetings, Jonathan Camarda, with a review of what we've just seen. We've had a little whiplash the last couple of weeks. Last time we spoke, the markets were tanking on a Friday, but little did we see what was coming Monday. So did want to recap what we saw, kind of review the whole carry trade unwinding you may have heard of, kind of give you a little quick diagnosis mechanically on that and what we've recovered and what it means going forward. So grab your popcorn and let's roll. This one's going to be a quicker one. So keep those seats belted. All right. So what did we see? Well, that Monday when we all woke up, right, the market was falling out of the sky. The world was ending. We've seen this. It was in 1987 again, etc. Well, again, the culprit that the quick unwind was, as you may have heard, the carry trade, the yen unwind. So what does this mean? Well, in a situation, large money managers, hedge funds, and institutional money were borrowing the Japanese yen, which usually is very low yielding. If you've seen the Japanese economy over the last few decades, the lowest rates, right? It's been a pretty weak economy until recently. So again, rates were pretty low. Carry trade is when investors either in currencies will usually borrow the lower yielding currency and then go long or invest in a higher yielding currency. So let's say borrow in yen, buy dollar, betting that that continues. Now the risk is things can unwind quickly. What money managers were doing in this high risk environment, they weren't just trading different currencies. Okay, they were going all the way to the bank, putting all the chips in the middle of the table. They were buying risky assets, think semiconductors. We'll leave the names to you. And borrowing in cheap yen and then investing in risky assets, further levering as the market was going up and really, really getting frothy in July. So we've had a reset. I'll get to why that's healthy in a minute. But so what happened? So the Bank of Japan came out and inconveniently, had raised rates, essentially getting a little bit more restrictive in policy. So what does that mean for all these institutional investors that had basically borrowed so much money is that they raised what they call the collateral level. So think you old timers, you know what I'm talking about, even older than me. Back in the day when you have a margin call, right, when you would short a stock, which means you would borrow to short it. And then if the stock moved against you, you would have to put more money in your account that they call a margin call. And of course, we've seen the movie Margin Call, but we're not going to go there now. But so what happens is when they're calling your bluff on this, like at the poker table, you have to increase collateral for that money that you put down, that loan, that very low financing rate. And so what most of these money managers have, they don't have the money. They have to sell the assets, right? Think a piece of real estate, a car, whatever part you were in your life that you had to do something quickly to gain that cash. Just think on a very huge macro, billions of dollars macro level, and you saw the unwind. They had to sell these high-flying stocks, these high-beta stocks, to then put enough onto the books to keep their books right with the Bank of Japan. So that's what you saw there. Not necessarily an economic situation. Now, the risk there is a lot of times when one shoe drops, one slipper drops, historically, volatility-wise, another one comes along. You don't know when, much like in tectonics with earthquakes, but that's not guaranteed. So it put us in a perilous position. The market was already weak the week before, right? The week before, from economic data. It was getting frothy. We have a slowness in the economy, right? We have home prices that are coming down. Your listing prices, if you watch real estate prices the way I do, you obviously have employment getting weaker. We've seen those numbers. We've seen the CPI number, all the numbers coming in showing a slowdown. Should, Jerry have lowered last time? Even we talked about it. A lot of stuff going into that pot of stew there. And essentially, it was ripe for a sell-off. Now, the market really corrected, especially on the NASDAQ, like 10%, a pretty quick, rapid downturn if you looked at volatility, and it got up to very, very, very precarious support levels around the 200-day moving average or just above, which is why you'll notice even in some of your aggressive accounts, again, we start to move some of the pawns on the chessboard to take into account. Now, we found support. Economic data's been somewhat supportive. Earnings overall this earnings season, we've had great earnings reports. Great. Well, they haven't been great, but they've been pretty solid. The problem has been the guidance. That's revenue projections have not been. There's projection of weakness, and that was already built in well before this carry trade hurricane that came through. No pun intended. And for those obviously in the state of Florida, definitely Godspeed if had any issues with that as well. That same Monday, by the way, rolling up through the coast. So here's the deal. The market has recovered. So you'll notice that in some of your aggressive accounts, again, we follow the tide to make sure that we are positioned correctly. And for you clients with new money coming in, if we had money on the sidelines, We then, once we reseeded based upon the volatility, then quickly put that money to work. You'll notice as well as we're just following the actual price movement and the institutional flows, as it were. Where does that put us now? Well, the market is in pretty firm footing. But again, August, September, and October are the most volatile times of year, so we have to definitely be cognizant. However, we have recovered some pretty serious levels. Markets over the last month still down since the July 15th highs, but recovering pretty nicely. Bonds as well hanging in there. If we look at the yield curve, right, still uninverting, de-inverting, however you want to say it. Okay, the 2-year yield still slightly higher than the 10, just slightly, but the 3, 5, and 7-year below the 10. And the 2, if you can keep up with all this is all by memory. I think it's right. You can look in the Wall Street Journal. Feel free to call to correct me. But the 2-year is still below the 30. So what does this all mean? That means that the hose is unwinding. Okay, the yield curve is unwinding from inverted to going back to normalization. Now that is when you usually see volatility. It's not when it inverts, which was like what 2 years ago. It's been crazy. One of the longest inversions that I can recall historically. But it's not the inversion. It's when it uninverts that you have to watch. Okay, that's when the grizzlies start to hunt. So in this situation, like I said, if you look at the National Association of Active Investment Managers, they dialed down from the 80s, 70s, and just this week, as they're always a little late on the fastball, got down to the 50% exposure across active money managers, whereas we never got that low. We played a little defense, and even aggressive accounts got from the mid 90s into the low 80s or high 70s, depending on your risk tolerance, and then back into the 80s. Very quick. We have to follow the action, especially in strategies and tax deferred accounts. So where we see things now, dollar is kind of stabilized. The yen is backing off from, again, that spike that we saw because of the recovery with the carry trade. So things are kind of been normalized. As we move through August, we shall see. We have Jackson Hole coming up, etc. Now, again, I will not pop back in with more of my blathering till I'll probably post in that Labor Day area. But I did want to touch base as we have had a little bit of whiplash since the last time we spoke. So I did want to kind of put a little bit of a period, not so much a semicolon, on the end of our last conversation. With all that being said, I try to enjoy the rest of your summer. Again, remember, most of the institutional traders are still in the Hamptons at the beach. Volumes tend to be low, so movement can get real crazy without a whole lot of weight behind it. Although some of those traders might have, told their spouses they got to get back to the offices a little earlier after what we saw last week. And most kids are going back to the school, especially in the South. It'll trickle down over the next few weeks up north. Back to school, back to work, back to maybe some more volatility. Might be thrown around a little bit in a roller coaster, but right now things are starting to normalize. So we definitely want to have money put to work. Again, Jonathan Camarda, we're going to stay eternally vigilant. Never sleep. Just like New York, you stay frosty. Till next time.